So let's start the session. Hello, everyone, and welcome to this webinar. We are here to discuss the post-election market outlook and what to expect of the market in the coming days. We must have seen that this week's market movement must have given some of the Z investors in the market a taste of what the bear market or what a stock market crash looks like, isn't it? Uh, a phenomena which most of the new joinees in the stock markets may not have witnessed. We saw the stocks falling 15 to 25% in a single day, lower circuits getting activated in various stocks. This is the reaction of the market. We normally see when it is disappointed with something, and the collective wisdom of the market takes it down further. So this week's market movement that we saw was a roller coaster ride where we saw initial euphoria, then a disaster, and again hopes and a building euphoria with a business as usual again. So a lot to learn from from this week's market movement. So first some flashback on Monday, we saw, which is June 3rd, we saw markets at record highs and their best performances in recent times we saw on Monday, June 3rd, with Nifty gaining about 700 points on back of the exit polls, where the pollsters in a poll of polls giving the ruling NDA around 370 seats. So the very next day on June 4th, what we saw was a reversal and a terrifying and a scary reversal. The lows made on the Sensex was 70,234, and on Nifty, the lows made was 21,281 points. The intraday fall in the Sensex was about 6,200 points, and in Nifty was 2,000 points, which is huge. Though it recovered some of the losses that it made intraday, but the magnitude of the fall was something which we had not witnessed in the recent times. The Nifty fell by about 6%, while the mid cap and the small cap index fell about 8 to 9%. The sectoral indices, such as the Nifty PSU banks, oils, metals, name it, and all of them shaved off between 12 to 15%. So, what caused it? Uh, we all know by now that the numbers were well below the exit poll prediction of 370 seats and the BJP's own ambitious target of 400 plus. So by the end of Tuesday, we were assured uh, that the NDA would be able to form the government comfortably and things would be as usual as far as the current economic policies are concerned. Now, what we saw the following 3 days, which is post Wednesday, Thursday, Friday, the market had recovered all of its election losses and it's back to its Monday euphoric highs. It's almost near the Monday highs. So the markets have now realized that the government would be able to run its regular policies without any hindrances, but would not have the majority that it had over the last two terms. Now, with such a mandate, it would be business as usual for all regular businesses and tough times for major structural changes. We expect the government to steer clear from the contentious issues like Uniform Civil Code, One Nation, One Poll, farm laws, etc. PM Modi, in his victory speech, has, however, affirmed that his commitments to reforms and growth will continue. For investors in the stock markets, it's more or less business as usual now. And the FPIs who were sellers till now are likely to remain negative to neutral on the markets in the short to near term. So, despite the reduced majority, we expect the policy agenda of the Modi 2 government, which was investment led growth, capex, infrastructure creation, manufacturing, defense, and all that to continue in this term as well, although with some tweaks. We also expect some populist measures to address the rural stress and lift the sentiments given the nature of the verdict. While the broader thrust on capex and investment led growth will continue, the agenda going forward would also now include measures which will revive the consumption at the bottom of the pyramid, and there could be some relief in taxation, and there could be rationalization in the GST structure as well. On the Friday, that is yesterday, on Friday, we saw the rally was extended uh, due to the outcome of the RBI policy. The RBI policy outcome was another trigger that led to further rally in the stock markets. So the MPC kept the repo rates unchanged at 6.5%, and the stance was unchanged at withdrawal of accommodation. So the RBI didn't give any indication of an early rate cut. So bond prices were largely unchanged because of that. And the central bank, as a result, set a massive rally in the stocks yesterday when it increased its growth forecast, GDP forecast for the current year to about from 7 to 7.2%. This upgrade in the GDP forecast could mean that the RBI is in no hurry uh, to cut rates, since the current rates are not harming growth in any way. Also, the RBI wants to see inflation aligning to the target of 4%. So, of course, the signs that a confident Narendra Modi will lead the next government. This also helped fuel further buying in the markets. Now, coming to the valuations, Indian equity valuations were already at highs, and the election results provided an ideal opportunity for the markets to correct a bit. Nonetheless, this was not the most favorable outcome that the markets were looking for. In this scenario, a lower valuation multiple is necessary to account for a coalition government risk and their impact on the reforms trajectory. So now I suggest investors should focus on selecting reasonably priced stocks with high earnings visibility, and it is not a time to pay a very high premium for stocks or to buy them solely on a hope of a future reform. So one has to take a little rational call now. On a medium to long term perspective, we have a positive view on the reform themes, and they remain intact. But the recent outperformance in PSUs, defense, power, capital goods, infrastructure stocks makes the valuation which rich now because it was driven by re-rating of multiples, while the actual earning or the actual execution in the order books, etc., is expected to be in the forthcoming years, and while the re-rating has already taken place. Thus, we expect some moderation in the valuation in the above space. In terms of sector preferences or cap preferences, we prefer large caps over small and mid caps due to the valuation comfort in the large caps. Near term, we expect the consumer space to benefit from a policy shift towards a more welfare measures, and also due to revival in the rural consumption due to normal monsoon. Private banks, among the banking space, private banks also offer some valuation comfort. Uh, IT, on the other hand, could also see revival in the H2 FY25 and attract investor interest. So, going forward, some of the key events that one can watch out, which could trigger a market reaction or which could shape the market movement in coming days and months, are the government and the cabinet formation, which is like immediately the onset of monsoon. A good monsoon is always good for the economy, uh, the agriculture, and the market. The budget, India budget, and the Q1 FY25 earnings, and the upcoming state assembly elections of Maharashtra, Haryana, and Jharkhand. So these are the triggers that we see in the coming months. So in conclusion, I would like to say that we are seeing decent economic recovery, economic growth at 8.2% of real GDP in FY24, but somewhere peaking of earnings growth and rich valuation in some pockets of the market. Nonetheless, we have maintained that the Nifty target, and we are retaining the Nifty target of 23,500 to 24,200 on the upper side. Uh, and volatility, we expect again to remain high till we have a clarity on the policy path. Financials still remain our top key overweight, and we have selective picks across sectors also. Defensives like IT and FMCG should also find a place in one's portfolio given their prolonged underperformance in the recent times. And also, there is a degree of safety attached to these sectors. So, we advise investors and traders to assign more weightage to large caps and these defensive sectors while maintaining some exposure to the infrastructure and capex theme stocks. And bets on small caps or micro caps should be avoided for now. So that's it. We can take questions. Participants can have their question posted. So there's one question on PSU Bank, whether it is right time to enter. So as I mentioned, in the banking space, the private banks offer more potential in terms of returns, as the underperformance has been high in the recent times versus the PSU space. PSU as a bucket, which comprise of the PSU banks, probably all other defense, power, they have outperformed a lot in the recent times. And no doubt, the story still is there, but the valuation is a bit stretched. So market right now is giving an opportunity to enter the non-performing names. So being contra, you're in investing in this sense, and this scenario right now will pay off more than going with the herd. So private banks is a space I would prefer over PSU banks. So there's one question on the outlook on the defense stocks. Um, Defense, despite reduced majority, we expect the upcoming government's policy to focus on investment-led growth, capex, infrastructure, manufacturing, and defense. This focus will continue. Even the order inflows for these defense companies for FY24 uh, were far ahead of the guidance that they had given earlier. So defense companies are doing well in terms of the order book, and even their numbers, their financial numbers are way ahead of expectations. But yes, the valuation are stretched here too, and you could book a partial profit in some of the defense stocks, especially BDL, HAL, and BEL. Partial profit booking, I would suggest about 20% profit booking to keep the capital safe, and then we could continue with the remaining holdings. Uh, as the policies, the government policies are expected to remain more or less the same. But yes, partial profit booking is advisable. So, one question on what is the outlook on the energy sector considering the increasing demand and future targets? What will be the allocation strategy across sectors? So, on the power sector specifically, the Modi 300-day power plan will be in place soon. And if we talk about stocks, NTPC is leading the way with 8.8 gigawatt of tenders announced this week. So we believe offshore wind subsidiaries could be postponed, but the hydro policy is important for India's net zero target. So I feel NTPC, NHPC, Power Grid, and even BAIL are key beneficiaries in the power sector, and focus and even allocation on these names can continue. So what level are we seeing in the market in next 6 months? So I said about 24,200 Nifty, which is a still good 1,000 points up from your that level we are seeing in the six coming months. And one question is, do we need to revisit and restructure the portfolio due to this? So yes, some restructuring is needed. In fact, at the tops, it is always best to weed out your uh, holdings in stocks, small cap and mini cap stocks, where you had bought just for based on tip or someone's recommendation. It's always better to realign the portfolio and focus more on quality large caps, blue chips, even quality mid caps, and even some good names in small caps where you have good, confirmation that the fundamentals are good. So in that sense, your advisor is the best person to guide you, and you can contact the advisor to realign your portfolio. He is the best person to, advise you exit on certain stocks and maintain hold on certain stocks. So yes, so it is always good to revisit your portfolio when markets are at all-time highs rather than restructuring the portfolio when the markets are in fall or lows. So one interesting question is, it is said that don't time the market, but during election result day, everyone is timing the market. Yeah, so this is the reaction that we saw on the result date was type of scary reaction. People were afraid that the current government or the Modi Sarkar will not be able to be in power or somewhere lose their stand. So that is the fear that the market was under, and it is also said that when everybody is fearful, that's the time you have to be greedy. So, timing the market versus getting scared, these are the different things. But on Tuesday, what we saw, even the best names in the industry, the topmost names in industries were surprised at the reaction that the market saw. But yeah, the very next day, the market gained sanity and we were back. So, which sectors look good from your as I said earlier, consumption names, as the government policies will focus more on the rural revival in those themes, and even the monsoon coming up, and expectations that the monsoon will be good. So, consumption names like FMCG, auto, these sectors will do well. And even we are bullish on IT sector, as IT is getting the status of a defensive sector now. So, even IT, and to some extent some part of the portfolio can be allocated to even the pharma sector. So there's one question that Indian markets are at a high P multiples, and how will such high valuation sustain? So one thought I have here is comparing this P multiple with a historical P multiple is not completely correct, because the stock composition and the sector composition of the Nifty index right now is very different from what Nifty was, say, 10, 20 years or 30 years earlier. So the index composition has changed, the sector weightage have changed. Banking now has a highest weightage, while some 20, 25 years ago, it was the energy and the PSUs which had the high weightage. So that ways we are not having an apple to apple comparison in terms of the P multiples. But yeah, that said, that the valuations are a bit on the higher side, and there could be some formation of bubble in few sectors, but it's not that that in any given market we don't find good undervalued stock. We do have some stocks which are still not discovered by the market and that are a part of our portfolio. So having a portfolio of 15 to 18 stocks with about 8 to 10 names in um, a comparatively high P stock, and remaining 8 in a undiscovered or stocks which have still margin of safety. So the overall portfolio performs well in that case, where we have a mix of high P stocks and undervalued or undiscovered names. So there are two questions on should one diversify the portfolio on the international side, on the international equity? Can somebody consider international equities? So yes, diversifying one's portfolio on the international side is always advisable, not because you want more return or something, but for diversifying your country risk, your currency risk, your uh, political risk. So, in that sense, we must have got a hint on Tuesday what just a political scenario triggers a correction. So, at that time, we could have thought that, if our portfolio had a bit of exposure, say 20 or 30% to probably US stocks or probably Japan or China, uh, our overall portfolio would have looked good. So, in that sense, diversification of the equity exposure in multi-country level is always advisable. Some portion should be in international equities, but a strategic call on which country and is to be taken place, that is something your advisor is the best person to guide you. And we do have an international equities team which looks into it, and they'll be the best people to guide you. So fresh allocation on FMCG, IT, as I mentioned, FMCG and IT, uh, we have also already started realigning a portfolio to these two sectors. We already had some exposure on IT, but we started increasing our exposure on IT and even the consumption space. Second was chemicals. Yeah, so chemicals, I still feel that we are still not out of the woods for the chemical sector, and still there is some scope of underperformance left for chemicals, um, because yeah, this FI 25 should be a story of monetization and restocking of volume traction and improvement across multiple end of the market. So somehow, still I would feel SRF, Aarti will be an underperformers, and yeah, it could underperform for some more time, I feel. So allocation on power, defense, PSUs in the existing portfolio will continue to remain. But as I said, some taking the profit off the table in defense, especially, I would say, is required, because I'm sure those invested in our portfolios must have made hefty profits, about 200 to 300% in defense names. So taking a partial profit and reducing the weightage, because with the rally, the weightage in defense stocks had gone up to 30%. So taking it back to about 15% will do no harm. So taking the weightage back to 15% or 10% of the overall exposure is advisable. And power and infra names, we will maintain the exposure, uh, and PSUs, invariably we will have PSUs in the portfolio, because power defense do have PSU companies. So yes, we will have exposure in these names. So hedging through commodities like gold and silver, should one hedge the portfolio? So gold and silver do have the privilege that they act as a hedge to equities. Yes, we have been advising having exposure in gold. Uh, Gold can form a small portion of their portfolio of about 5%, not more than 5%, because the rallies in gold are very concentrated. So some years in a decade we see that the gold is performing well, and then gold gives a very flat performance rest of the decade. So gold should not have more than 5% weightage in one's portfolio. So there's one question on view on EV and the related sectors. So India is aiming to boost EV sales significantly by 2030, so it is aiming for India is aiming for private cars to make up 30% of the total market, and commercial vehicles 70%, and buses 40%. So India is also looking for 100% of EVs to be produced locally through its Make in India initiative. So yeah, EV stocks, be it two-wheeler or batteries, or even stocks like Tata Elxsi or KPIT Tech look good. Um, yes, but yeah, but EV theme is not a very new theme now. It's been well accepted theme in the market, And yes, these stocks do look good still now. So one question on any specific stock suggestion from long-term perspective. We do have some stocks like Viatech, Wabag, Kirloskar Brothers, and even one can enter some defense stocks if there is some correction in them. And power names like we're bullish on NTPC, Power Grid, uh, yes, and infrastructure stocks like LNT. So these stocks can form a part of their long-term portfolios. So investing huge amounts in small caps, yes, I will go with the view that investing very huge amount in small caps should be avoided. You should always maintain a balance between various capitalization, with the large cap forming the most weightage in your portfolio, and mid cap the next weightage, and the small cap the least weightage in that sense. So large cap should always have at least 50% weightage in your portfolio. So there's one question on SBI AMC and NSE listing. There's no clear timeline on uh, the listing of both these stocks, and NSE is still waiting for the SBI for the SEBI's green signal to begin the IPO process. So there is still no clarity on the listing of both these stocks. So your view on real estate stocks, I would say that the Modi government would announce the much awaited revamped affordable housing scheme in the coming budget. So the coming budget is something to watch out very closely, and we expect some schemes on the affordable housing front. The revamped scheme in the affordable housing space could improve the affordability and lift the growth in the affordable housing loans. So affordable housing companies like Home First, Avas, companies like that could be direct beneficiaries. while large housing finance companies with presence in mid-ticket segments like LIC Housing, Canfin, that saw growth slowing in FY24 can also see some tailwinds in that sense. So uh, we would prefer home first and Awas amongst the affordable housing and so one question on Suzlon. Um, though we don't track Suzlon very closely fundamentally, but on the price movement front, Suzlon has done extremely well from a low of 11 or 12 rupees. It's about 50 rupees now. So in that sense, price performance wise, Suzlon at least is doing too well. And at least I see prices to go up to 55 or 56 from here. So I think we can end the session. I hope the investors gained a bit from this session and they will maintain their trust in the Indian markets. For any queries relating to the portfolios or the ones who want to be associated with Fintoo in terms of advisory or equities, can connect with our advisors. Um, yeah, so that's it from our side. Have a nice day ahead.